Good afternoon, ladies and gentlemen. My name's Louise Walsh. I'm the CEO of the Future Generation Investment Companies, FGX and FGG. Welcome to this afternoon's shareholder update presentation on both companies. Thank you to those of you that were here previously for the investment forum as well. Next time we'll make sure we have shorter breaks, so apologies about that you've had to sort of wait around a little bit. How we're going to run this is a bit different to how we normally do the shareholder update presentations. Normally we have a small panel along with Jeff and myself of fund managers, but also of charities as well. And because we did the investment forum earlier and we've got the AGMs later, this time round we're just doing, Jeff and I, doing the update for shareholders. And in other states it'll be the other format. So I'll start off with doing a quick update on both companies, more a general overview and update. And Jeff, as director of both companies and also chairman of the investment committee for FGX and on the investment committee for FGG, will specifically cover investment performance. So we'll particularly focus on that. And we'll try and give you around about 10 to 15 minutes for questions as well before we kick off with the AGMs from 4 o'clock. So just firstly, our disclaimer. Just to recap, the two companies are Australia's first listed philanthropic wealth creation vehicles, where we have prominent fund managers who are acting pro bono, so waiving their normal management and performance fees. And that generosity from the fund managers actually enables us to donate 1% of our net assets per annum to charity. So to youth at risk or children at risk charities in the case of FGX and youth mental health in the case of FGG. It is very much a win-win-win, and certainly for investors it's a win because you're not actually being charged the normal investment and performance fees that you would be if you actually invested directly with any of these individual fund managers. And the 1%, of course, is the only factor there that's going to charity. So no management fees, no performance fees. Secondly, it's a win for obviously the charities, the chosen charities that we do support, the 14 in FGX and the 8 in FGG, because if they play their cards right and perform and we can see the impact and we can measure the outcomes over time, we will continue to fund those non-profits, and it should be the case that it'll be an increasing stream of income for them as well. So that's why it's a particular win for the non-profits. And last but not least, the fund managers are very, very happy to be involved because, as you saw earlier, we create an event like the Investment Forum and it gives them profile. There's more awareness about what they're doing in their funds, and they like to be giving back and making a difference in the community by supporting what we're doing as well. Just to recap on the investment objectives, I think you're all familiar with these, but certainly the first one is a stream of fully franked dividends to achieve capital growth, and last but not least to preserve shareholder capital. And Jeff will talk a little bit about the allocation a bit later on. Now first, if we look at FGX, we absolutely want to thank each and every one of these fund managers in FGX for their generosity in being part of what we're doing. And if you were at the investment forum, you heard from some of these fund managers firsthand. So we currently have 20 funds that are managed by 19 fund managers, and we'd particularly like to welcome Vinva on board as one of our newest fund managers for FGX. And in fact, they actually joined the group this week. So they're a quant larger cap manager, and they've consistently outperformed over time. The 14 non-profits in FGX that we're supporting, most of these operate nationally, and they're particularly focused in the children at risk space. They report 6 monthly to us, and their latest 6 monthly report is actually due on the 31st of May. So when shareholders vote in August on where the 1% donation goes, we'll certainly have the benefit of looking at the latest reports from these FGX charities, and we'll be sharing that with you. So you can see and read firsthand what the donation money has been spent on in the last 12 months and where it's going to be spent in the following 12 months. Our service providers, so these are the pro bono service providers, like, for instance, Cardos Scanlon, who are our law firm that generously provide our legal services pro bono. So we're very much thank these service providers as well as our fund managers. If we look at some of the highlights, we're talking about a transitional reporting period here for the 6 months to 31 December 2016. And the reason it is transitional is you'll be aware that we actually changed our financial year end from 30 June to 31 December to better align the reporting period to the underlying fund manager distribution. So just to recap here, we had a 2.1 cents per share fully franked dividend, a 5% increase on the last dividend. Savings of an estimated 5.54 million, and these are savings that are delivered from the pro bono management and performance fees from our fund managers, and also the pro bono service providers, including our board members and committee members who've given up their time pro bono as well. So that annualised estimate to 30 June is 5.54 million. A 2.74 million pre-tax profit result, and we're on track to donate 3.82 million to Australian children and youth at risk charities, and that donation will be happening from October this year. So that this year's donation, assuming it's 3.82 or thereabouts, will be a 66.8% increase on last year's donation. So you can see it's quite a big increase. The dividend, I mentioned this before, but just to recap, we're looking at an annualised 2017 fully franked dividend of 4.2 cents. The next dividend will be announced in August. Just here is just a small summary of the impact of the charity work. This will be detailed in more detail when you do the voting process in August, but there's some incredibly strong results that are happening here. I think this morning the Australian Indigenous Education Foundation was mentioned, and on this slide here, you know, we've been able to support scholarships for 7 young Indigenous Australians to come to boarding school, private schools around the country. That wouldn't have happened without this funding. Even on the second slide, you know, early literacy programs that are happening in Western Sydney, that are happening for 300 children aged between 0 and 5, and the younger we can do this work in the early intervention space, the better. Just now flipping over to FGG, Future Generation Global. So just a few highlights on the sister company, the Global Equities Company. These are our fund managers, and we currently have 13 fund managers in FGG that with 15 funds, and Jeff will elaborate on some of the adjustments that we've made by the investment committee in recent months. And we really want to thank these fund managers again for their generosity in waiving their fees. The charities, we have 8 non-profits or charities that are focused on youth mental health. They had their first donation last October, and we've recently completed a customised social impact evaluation report. So this is a reporting framework that these charities have to report against. That reporting will happen in July this year, and you'll see the benefits of that when you do the voting process in August. We've just completed a new website for the Future Generation companies, and that website now has up on it the social impact evaluation reporting framework. So if you're particularly interested in that side of things, please take a look at that. The service providers, very similar group of service providers as we have for FGX, and just looking at some of the highlights again for the transitional period for the 6 months to 31 December. A particular highlight here would be the savings of an estimated 4.34 million. That's an annualised estimate to 30 June of 2017, and that's the foregone management and performance fees by the fund managers, and also the value of the pro bono service providers, so totalling 4.34 million. We're on track to donate an estimated 3 million to youth mental health charities in October this year, and the other highlight has been the 7.8% increase in the investment portfolio performance for that 6-month period. Last but not least, just finally on the dividend front, the inaugural dividend was announced in August last year of 1 cent fully franked dividend, and we will announce the next dividend, assuming, depending on profits and distributions from the fund managers for the previous 12-month period. That'll be announced in August coming up. A big milestone date for us is 15 September this year. The option exercise price is $1.10, and we're certainly watching that share price very closely on a daily rate at the moment, because it is starting to creep up, which is the good news. So they expire on the 15th of September, and Jeff will talk a little bit more about that. So what I might do is hand over to Jeff to talk on the performance and side of things. Thanks, Jeff.
Thanks, Louise. Great. Thanks very much, and welcome everyone. Okay, before I start going through the slides, what both investment committees have tried to do is put together a portfolio of fund managers that will probably achieve, in theory, the holy grail of investing, and that is difficult. And so what that is minimise your downside risk and maximise your upside return. And so broadly, how the investment committees have worked out how to do this is, broadly they're saying, look, to achieve this, we need exposure to the market. So let's get the best fund managers we can find, and the ones that invest 100% of your money in the market, but outperform over time. And coupled with that, let's get another group of fund managers that are looking at more absolute type returns, where they can hold cash, or if required, they might short some shares, etc. So broadly, for both FGX and FGG investment committees, that's what they're trying to achieve. And what they're trying to achieve is, normally say the market goes like this and ends up higher over time, but to give shareholders a return of this. It's risk minimisation, and probably over the period we're looking at for both FGX and FGG, it has been a very strong market, and because we've got various defensive characteristics from these fund managers, then it's more difficult to outperform in those just very strong markets. Now that's the FGX performance. If you look at probably look at the far right-hand side, the standard deviation, which effectively is the risk of the portfolio. It's how much the portfolio moves around. And the market, the All Ords standard deviation over that, since inception was 12.5%. So it jumped around quite a bit. And the portfolio at the top was 7.2%. And that's obviously you want the less risk. And just looking down at the Small Ords was 13.6, and that's what you'd expect. The smaller companies are higher risk. So you'd assume that this, the standard deviation or the volatility was higher. In terms of the returns, with that volatility, to get a return since inception that beat the market is actually is very incredibly commendable in terms of the various the fund managers we've been using to get that. Now, if you look more recently, go to the far left-hand side, looking at this year, the performance hasn't been that great. Now, why hasn't it been that great? Is because a couple of factors. One is the market neutral and the more absolute fund managers obviously are holding quite a bit of cash in terms of trying to protect your assets. And in a strong market, which has really been has been very much, the Australian market has been led by the leaders over this period of time, and also the fact that in terms of looking at fund managers in Australia that add value, the guys that have tended to add value over time tend to be focused more on the mid and small cap area. So the FGX portfolio definitely has those characteristics of exposure, a significantly greater exposure to that sector of the market. So they're the numbers there. I mean, that's the NTA. It's trading at a slight discount to NTA, FGX, which, and probably relevant for FGX and FGG, what's important for listed investment companies? One is to perform. One is, where you can, if you're a domestic manager, a good fully franked dividend. Global manager, it's obviously a lot harder. Thirdly is to treat shareholders with respect, and just on that, the boards of both companies have been approached a number of times to potentially raise capital for people that had missed out on the IPO and wanted a big block of stock, and the boards have decided not to do that because they didn't think it was in shareholders' interests necessarily. And the fourth one is to communicate efficiently and effectively with your shareholders, and also market to get potentially additional shareholders. And you would have, if you were here for the forum earlier on, that is part of the process, and this 6-monthly presentation is also part of the process. So that's that. And in terms of, that's broadly how the FGX portfolio is set up. That cash level is going to reduce slightly when there's another, I think 2.5% of the portfolio has been put into one of the quant large cap manager, which is but broadly, broadly what we're looking at is trying to have close to 50% long only, and the other 50% a combination of those market neutral absolute managers and cash. So we also, over the period with FGX, the options were exercised over that period, and there was a little bit of a cash drag from that money coming in from the options. So in a strong market, obviously that's not good for you. In a weak market, that is. But that's broadly how the money's allocated between the managers. In terms of FGG, the global one, their performance, again, looking at the far right, the standard deviation, less risk or less volatility than the market. And actually, when the investment committee put the portfolio together, and all of you, if you received the annual reports, there's a great piece. What page is that, Louise, in the annual report? In the investment report, was it?
Pages 6 and 7.
Yeah, 6 and 7, just showing you how the assets are allocated. There was a skew to Asia when the portfolio was put together, and when we selected the best, we looked at 90 global fund managers in Australia, or that you get access to in Australia, and we picked the top, was it 15? Some of them, we also went directly into some of the Asian funds of those managers. And that was, an example is Antipodes, very good manager. Jacob Mitchell, number 2 at Platinum's done an extremely good job. We were his first, I think, institutional client. But when he was raising the money, he said, look, I'm happy to give you capacity for global, but I also, of that, say 50 million of capacity, I want you to put some money in the Asian fund as well. And when we invested with these managers, we said that we won't put any more than, that we won't be on investment any more than 10% of our funds will be in any one manager. So when we put all the fund managers through the optimiser, then we were trying to get exposure to the global markets as the MSCI gives you exposure, but we ended up with a skew to Asia, and you can see that And what we've decided, we're happy to accept that skew, which in theory Asia gives you, it's more volatile, more risk. So in theory, if you took the Asian skew out, the volatility of the FGG portfolio, maybe down to 8 or something like, it would be a lot less volatile. And now that we've been going for a period of time, and the managers, we've built the relationship with the managers, then the investment committee has decided to remove that Asian skew, and any direct exposure to Asia or the managers is being removed. And you'll see we've still got, at the end of last month, still 2 Asian funds in there, but they will be rotated out over time. And the FGG portfolio has done probably more work on adjusting the managers than the FGX portfolio. And there's been, how many managers? 4 managers. 4 managers have been removed. Now, some have been removed specifically to remove that Asian tilt, and there's been various other reasons why they've been removed. And the whole idea of removing the manager is because we believe that we can get a better return, or they're not delivering what we wanted them to deliver, or we think there's risk with that manager. I mean, that's effectively what we've been doing with that, and that's the NTA. And I mean, that NTA announcement only came out last Friday. The portfolio was up 3.8% last month. 1.8% of that was the weakness in the Australian dollar. Obviously, this is, FGG is an unhedged portfolio, and I think what happened is FGG. We all, when FGG floated $1.10. The NTA on day one after costs, the broker's cost was about a little over $1.08, and it did go. The share price did go to a significant premium. It went to $1.20, and then that was when the Australian dollar, when we floated, the Australian dollar was around 70 cents. It kept falling, and then when the Australian dollar rallied to the high 70s, what my observation is, there was a lot of people that had played FGG for the weakness in the Australian dollar, just decided, okay, well, I'm going to rotate out of that. It was just a pure Australian dollar play. And so effectively, as it's a supply-demand equation, we've got to work through that. And you'll see today, like the stock's trading $1.08, $1.08.50, still a reasonable discount to NTA, but nearly 1 million shares traded. So that's just a process that you go through. Look, I mean, you would have seen I've been buying them because I think of all the funds we're involved in, the FGG is the biggest discount to NTA. And we assume that'll dissipate over time. Obviously, with FGG, we also have the options outstanding. So if you fully dilute that NTA, because anyone who put their money in the IPO got a free option as well, then that's $1.12.7 fully diluted. And when those options, either they get exercised or they don't, depending on how effectively where the share price is and how the funds perform. And what you tend to find is, and we found this with FGX, when the options disappear, then it just takes a bit of pressure off the stock, because people have only got one security they could buy. That's how the assets are allocated, so broadly again that 50% either side, and they're the individual fund managers. The various allocations. Then, as I said, there'll be the bottom 2 managers, which are direct Asian exposures of other managers, will be rotating out of them over time. So is that me, Louise?
Yes.
Yeah. Thanks.